Great to have you back. We were just talking during the break about some of the wood that's gotten chopped, you could argue, in stocks and bonds this year, pricing in some not great outcomes.
So we show a four-corner quadrant of stock bond returns over the last 60 years. There is nothing that looks like 2022, okay, in terms of the combined stock bond portfolio. But when we think about it, the kind of pain that we as investors have all felt this year, you go back to spring of 2020, you go back to March of 2009, you go back to the fall of 2002. These are the times when you want to recommit to your long-term investment discipline and put money to work.
Is that contingent on yields coming down?
It's a very important part of the equation. And from where we sit, look, part of the fact, and I think people don't want to fully admit this, is A, if you think about inflation expectations, they're reasonably well contained. We're starting to see signs of deceleration. Obviously, the housing data today is more proof that bond yields likely have further to fall. It's an important part of the equation, but we think it's an intact part of the equation.
How about earnings for next year? Do you think that they're taking into account a recession in 23?
They are. We are showing flat year-on-year growth, 22 into 23, but actually when we talk to our clients, they are expecting a modest recession. That would not be a surprise. But again, when you think about it in terms of the positioning and the really negative sentiment, very similar to the setup in July, we feel like it's in the price, and you can't argue with seasonality.
Well, speaking of seasonality, Julian, your most recent note talked about tax loss selling, mutual funds and individuals, as well as we end the mutual fund year very soon.
Right.
And the full year, obviously, for everybody else. What's the impact going to be?
It's as big a concept in terms of flows as we've seen in years, and obviously rightly so. But this is one of these occasions where, you're throwing out the good stocks with the bad stocks. There's an entire universe of companies that have good earnings in 22, positive expected growth in 23, and importantly, considering this is a game of expectations, upwardly revised earnings expectations for 2023, down 50 to 60% from their pandemic highs. Those are the kinds of names we want to own.
Is it too early to already judge this earnings season? Obviously, we still got a ways to go, but we've been hearing for many significant bellwether companies. Any thoughts?
It's not great. It's definitely not great. We'll surprise by a little bit, much less than normal. But again, it is part of the expectational equation here that goes into the idea that if we were to get, and we're not saying we're going to, but if we were to get any sort of positive earnings growth next year, there's upside to where stocks can go.
But I guess the point I keep coming back to, and we touched on this with UPS earlier in the hour too, is how much of this is reversion to the mean in terms of profitability and the fact that we had this huge spike over the last 2 years and a huge wave of liquidity and stimulus, and how much of this is really telltale signs of recession setting in?
So the issue, Morgan, is that when you look at everything, you can argue there's a reversion to the mean. We had 11 fantastic years in the stock market. Now we've got 2022. We had record increase in the money supply to fight the pandemic in 2020, and now we're likely to have negative with QT. The same thing is happening in terms of corporate earnings. But the interesting secret is that even when you get potentially flat years in earnings, it doesn't necessarily mean stocks go down, because we are coming close to being priced again for that mild recession that may not happen.